Hello, everyone, and welcome back to the Royalties Podcast. As always, I'm your host, Clarck Cadet, ready to guide you through the complexities of Canadian finance. Today, we're diving into a timely and critical topic: navigating rising interest rates. Man, the struggle is real, but we'll explore how these increases affect loans and mortgages and share strategies for managing your debt effectively in this new economic environment. To help us understand these challenges, we'll follow the story of Leah, a homeowner from Toronto, as she navigates through the rising tide of interest rates. Interest rates, man. The reason I sigh is because they're so unstable and they affect so many different things. But today I'm going to make sure you understand what they affect and how to deal with them. Understanding interest rates. First, let's set the stage by understanding what it means when interest rates rise. Central banks, like the Bank of Canada, may increase rates to manage economic growth and inflation. While this can be stability, I struggle to even use that word, but okay, while this can stabilize the economy, it also means higher borrowing costs for consumers. Higher interest rates affect loans and mortgages, increasing monthly payments and the total amount paid over time. Let me tell you about Leah. So, she bought her home with a variable rate mortgage. While the initial rates were low and affordable, recent economic shifts led to increased rates, and Leah found her monthly mortgage payments creeping up, straining her budget. Now, don't ask me whether variable or fixed is better. It all depends on your situation, but she went with variable, understandably so in that situation, but let me show you how it impacted her. So the impact on loans and mortgages. So as Leah experienced, rising interest rates directly impact those with variable rates, loans, and mortgages. Here's what happens. Variable rate mortgages. The interest rate changes based on market, right? If these go up, so do your payments. Fixed rate loans. If you're locked into a fixed rate, you won't be affected during the current term, but refinancing or new loans will be at higher rates. So you're gambling a little bit, right? The variable rate, it all depends on how you look at it, but for most people, it ends up being more favorable. But fixed rate is good for people who are like, I can't afford to have my rate go up or down. I just need to be able to know what my payment is every month. To each his own. Lines of credits and credit cards. Hear me out now. These typically have variable rates, so you might see higher interest rate charges on an outstanding balance. So Leah's strategy for managing her mortgage. Leah took proactive steps to manage her rising mortgage costs effectively. Refinancing her mortgage, she considered refinancing to a fixed mortgage rate to stabilize her monthly payments and protect herself against future rate increases. Extra payments. When possible, Leah made additional payments on her mortgage principal during lower rate periods, reducing the total interest rate she would pay over time. I'm going to repeat that. Leah made additional payments on her mortgage principal during lower rate periods, reducing the total interest she would pay over time. When you work with me, I give you all these strategies. People say, I don't want to pay my mortgage in 30 years. I want to pay it in 20 years, but I don't know how to do so. I give you those strategies and I show you how to do it. And I lead by example, but that's another discussion. General debt management strategies. For our listeners thinking about how to manage their debts amid rising rates, consider these strategies, okay? Hear me out. Actually, take notes, I suggest. Debt consultation, or consolidation, should I say. Consolidating multiple debts into a single loan with a lower interest rate can help reduce monthly payments and simplify your finances. If you've got credit cards all over the place, 30%, 22%, 24%, get it together. If you can't do it on your own, obviously come reach out to a credit coach like me and I'm going to get you set up. We can reconsolidate. And by reconsolidate, it doesn't mean going to go take a loan specifically. There's other ways to do so because there's pros and cons to debt consolidation. So just make sure you talk to a professional that can help you with that. Fixed rates. Where possible, lock in fixed rates for loans or mortgages to avoid the uncertainty of variable rates. Pretty simple, right? Emergency fund. I just talked about it in the last episode. I'm going to talk about it this one and probably in the next one. Boost your emergency fund. Having extra savings can help you manage unexpected increases in payments without falling into more debt. If you don't have a savings, you don't have a cushion, you're not doing the right thing. But you can never save if you have debt. So you knock out your debts first, and then you save. Why? Because when you have debts, you're paying interest out. You're giving money away for free, and you know how much I hate giving away money. So work on the debts, clear, and then start savings. Don't know how? You know who to talk to. Listen, plan for specific needs. Plan for emergencies. Just plan. And if you don't know how, contact me. I got you. Adapting to her new financial reality, Leah successfully managed to restructure her debt and continues to stay on top of her financial obligations despite the challenging economy or economic environment, should I say. Her proactive measures not only safeguarded her home, but also her peace of mind. And working with me as her coach, we're able to get Leah from I'm not sure what's going to happen with my mortgage to I have savings and a cushion to I have lines of credit to I can start my business ventures and I have a safety cushion. If this sounds like what you want, www.clarkcadet.com. But let's get through that. Let's continue on. Leah, just like you can navigate the challenges of rising interest rates with informed decisions and proactive financial management. It's about understanding the landscape, assessing your vulnerabilities, and taking decisive action to protect your financial health. Anyway, thanks for tuning into the Royalties Podcast. If you found today's discussion helpful, please share it with someone who might be facing similar financial challenges. Remember, staying informed is your first defense against the rising tide of interest rates. Until next time, keep planning, keep learning, and stay financially savvy. Make sure you like, follow, and share. Tell a friend to tell a friend. Let's bring financial literacy to the end. It starts here with me. You know what I do. Ask around. Just ask anyone. Barbershops, hair shops, nail shops. If you're talking about financial literacy and credit, you're talking about me. And I'm here with you. So let's get busy together. You.